The phone call from Wells Fargo corporate banking came at 10:23 a.m. on a Thursday, and I knew from the first sentence that something had gone catastrophically wrong with the Meridian acquisition payment. Ms. Harper, this is David Chen from Wells Fargo's Fraud Prevention and Risk Management Division. We've flagged a wire transfer authorization from Lexington Technologies for $180 million to Meridian Systems escrow account. The authorization signature doesn't match our records for approved signatories on transactions of this magnitude, and we need verbal confirmation from an authorized representative before we can process this transfer. My stomach dropped through the floor, through the building foundation, and probably ended up somewhere near the Earth's core, because I knew exactly what had happened. Tyler Lexington, our CEO's 26-year-old nephew who'd been promoted to VP of Corporate Development 3 weeks ago despite having approximately zero experience in mergers and acquisitions, had tried to authorize a $180 million wire transfer without understanding that banks have very specific protocols about who can move 9-figure sums and that those protocols don't give a damn about your last name or your uncle's corner office. I'm Morgan Harper, and I'd been Director of Treasury Operations at Lexington Technologies for 11 years, 7 months, and 23 days, which meant I was the person who actually understood how our banking relationships worked, which signatures were registered for what transaction limits, and most importantly, what happened when inexperienced executives tried to execute complex financial transactions without consulting the people who'd spent over a decade building the institutional knowledge and banking relationships that kept hundreds of millions of dollars flowing correctly through proper channels. I wasn't the executive who attended board meetings or made strategic decisions about acquisitions. I drove a 7-year-old Subaru Outback with 142,000 miles on it and a collection of coffee-stained travel mugs in the cup holders because I spent more time thinking about wire transfer protocols than about vehicle cleanliness. I lived in a modest townhouse with a small patio where I'd planted herbs. I kept forgetting to water and furniture that was comfortable rather than impressive. I was the person who made sure money moved where it was supposed to move, when it was supposed to move, through channels that satisfied banking regulations, anti-money laundering requirements, and fraud prevention protocols that existed because financial institutions had learned expensive lessons about what happens when you don't verify large transactions properly. The trouble had started 6 months ago when James Lexington, our founder and CEO, decided that family succession planning was more important than operational competence. His nephew Tyler had graduated from business school 3 years ago, worked briefly at a consulting firm where he'd mainly made PowerPoint presentations, and was now being groomed to eventually take over the company through a series of promotions that had nothing to do with qualifications and everything to do with sharing DNA with the founder. Tyler's first position was Strategic Initiatives Manager, a made-up role that involved attending meetings and contributing observations that sounded strategic if you didn't think about them too carefully. 6 months later, he was promoted to Senior Director of Business Development, where he was supposed to be identifying acquisition targets and growth opportunities. 3 weeks ago, he'd been promoted again to VP of Corporate Development and given responsibility for managing the Meridian Systems acquisition, a $180 million transaction that represented the largest deal in Lexington Technologies' 20-year history. The Meridian acquisition was complex. We were buying a software company with offices in 4 countries, revenue recognition across multiple currencies, existing debt obligations that needed to be refinanced, employee stock options that needed to be cashed out, and regulatory approvals required in 3 different jurisdictions. The deal structure involved an initial payment of $180 million to an escrow account, which would be held pending final regulatory approvals before being disbursed to Meridian's shareholders. The escrow agent was a major law firm, the wire instructions were detailed and specific, and the banking authorization requirements were crystal clear. Any wire transfer over $50 million required signatures from 2 authorized officers on our corporate resolution filed with Wells Fargo, plus verbal confirmation from our designated treasury contact. I'd been managing Lexington's banking relationships for over a decade. I was listed as the primary treasury contact for all major banks. I'd personally registered the authorized signatories for large transactions, updated the corporate resolutions when executives changed, and maintained the relationships with bank officers who handled fraud prevention and risk management. For a $180 million wire transfer, our bank required signatures from the CEO and CFO, plus my verbal confirmation that the transaction was legitimate and authorized. Tyler knew none of this. Because Tyler had been promoted 3 times in 6 months without actually learning how corporate finance, treasury operations, or banking relationships functioned in the real world. On November 8, Tyler held a meeting about finalizing the Meridian acquisition payment. Present were James Lexington, CEO, Patricia Wong, CFO, myself, and Tyler's assistant, who took notes and nodded at everything Tyler said. Tyler had printed out the wire transfer authorization form from our banking portal and filled it out with details from the Meridian deal documents. The regulatory approvals came through yesterday, Tyler announced. We're clear about sending the escrow payment. I've prepared the wire authorization for $180 million to Meridian's escrow account. James and Patricia, I need your signatures here and here. He slid the form across the table, pointing at signature lines. I raised my hand. Tyler, before they sign, we need to review the banking authorization protocols for transactions of this size. Wells Fargo requires. I've handled wire transfers before, Morgan. This is straightforward. We just need the signatures and then I'll submit it to the bank. Wire transfers over $50 million require specific authorization procedures, including verbal confirmation from the Treasury. Have you coordinated with the bank's corporate team about the timing and confirmation protocols? I'll handle the bank submission. You don't need to be involved in every detail. James signed the form. Patricia signed the form. Tyler collected it with the satisfaction of someone who thought signing a piece of paper was the same as understanding how institutional banking actually worked. Tyler, I tried again. I need to coordinate with Wells Fargo before you submit this. The bank's fraud prevention team will need verbal confirmation from me as the registered Treasury contact. If you submit this without proper coordination, it could delay the transfer or trigger fraud alerts. Thanks for the input, Morgan, but I've got this under control. I'll email the authorization to the bank this afternoon. I left that meeting with a bad feeling that got worse when I checked our Wells Fargo corporate banking portal and saw that Tyler had indeed submitted the wire authorization at 4:47 p.m. that afternoon without coordinating with me, without notifying the bank's corporate relationship team, and without understanding that a $180 million wire transfer from a VP who wasn't registered as an authorized signatory for transactions of that magnitude would trigger every fraud prevention protocol Wells Fargo had implemented. The next morning, November 9 at 10:23 a.m., David Shen from Wells Fargo called me. Ms. Harper, we've received a wire authorization for $180 million submitted by Tyler Lexington, who's listed as VP of Corporate Development. However, our records show authorized signatories for transactions over $50 million are James Lexington and Patricia Wong, with mandatory Treasury confirmation from you as the registered contact. Tyler Lexington isn't registered as an authorized signatory for transactions of any amount. The authorization has signatures that appear to be from James and Patricia, but the submission came from someone not authorized to initiate transactions of this magnitude, which triggers our fraud prevention protocols. We need you to confirm this is a legitimate transaction before we can process it. It's legitimate. This is the Meridian Systems acquisition escrow payment. Tyler is managing the deal, but he's not familiar with our banking authorization procedures. The signatures are genuine. I was in the meeting when they were provided. I understand, but we have additional concerns. The wire instructions show the receiving account is an escrow account at Morrison & Sterling Law Firm. For transactions of this size going to law firm escrow accounts, we require additional documentation showing the underlying transaction purpose, confirmation that all parties have been verified, and proof that proper anti-money laundering due diligence has been completed. This is standard protocol for large escrow transactions to prevent fraud and money laundering. I can provide all that documentation. We have the full acquisition agreement, regulatory approvals, escrow instructions, and due diligence files. We'll need you to submit that documentation through our secure portal along with written confirmation from U.S. Treasury Director that this transaction has been properly authorized and reviewed. Until we receive that documentation and confirmation, the wire transfer is frozen. Now, about 81% of you listening to this haven't subscribed yet, and that's like watching someone try to unfreeze $180 million while their CEO's nephew learns expensive lessons about banking protocols, and deciding you don't want to see how it ends. Subscribe right now. Because what happens when nepotism crashes into institutional banking requirements is a masterclass in why experience matters more than family connections. I hung up with David Chen and immediately went to Tyler's office. He was on his phone scrolling through what appeared to be LinkedIn when I walked in. Tyler, Wells Fargo froze the Meridian wire transfer. They need additional documentation and treasury confirmation before they'll process it. He looked up, annoyed. Why would they freeze it? I submitted the authorization yesterday. Because you're not registered as an authorized signatory for transactions over $50 million, you didn't coordinate with the bank's corporate team, and you didn't provide the required documentation for large escrow payments. The bank's fraud prevention protocols flagged this as suspicious because someone unauthorized tried to move $180 million. That's ridiculous. James and Patricia signed the authorization. Their signatures should be sufficient. Their signatures are sufficient for authorization, but the submission process requires coordination through the Treasury for transactions of this size. The bank needs confirmation from me that this is legitimate, plus supporting documentation showing the underlying transaction purpose and anti-money laundering compliance. I'm managing this acquisition. I don't need you confirming my transactions with the bank. Tyler, this isn't about territory. This is about banking regulations and fraud prevention protocols. Wells Fargo isn't going to release $180 million based solely on your submission when you're not registered in their systems as someone authorized to initiate these transactions. I need to provide the confirmation and documentation they're requesting or this wire transfer stays frozen. Just call the bank and tell them to process it. I will, after I gather the documentation they require and submit it through proper channels. This will take a few hours to compile everything they need. Tyler's expression hardened. The Meridian deal closes tomorrow. If this payment doesn't hit escrow by the end of business today, we'll miss the closing deadline and potentially lose the acquisition. James is going to be furious if this deal falls apart because of banking bureaucracy. James will be more furious if we lose the acquisition because you tried to handle a $180 million wire transfer without understanding banking authorization protocols and I didn't fix it. I left Tyler's office and spent the next 4 hours compiling documentation for Wells Fargo, the complete Meridian acquisition agreement showing the transaction purpose, regulatory approval letters proving the deal was legitimate, escrow instructions from Morrison and Sterling confirming the receiving account, anti-money laundering due diligence reports showing we'd verified Meridian's ownership structure, and written confirmation from me as Treasury Director that this transaction was properly authorized and reviewed. At 3:47 p.m., I submitted everything through Wells Fargo's secure portal along with written confirmation. At 4:23 p.m., David Chen called me back. Ms. Harper, we've reviewed your documentation. Everything is in order. We're releasing the wire transfer now. The funds should hit the escrow account within 2 hours. Thank you, David. For future transactions of this size, please route all coordination through me directly. Tyler Lexington is managing the corporate development function, but he's not familiar with banking authorization procedures yet. Understood. We've added a note to your account flagging that large transaction coordination should go through you as Treasury Director regardless of who initiates the paperwork. At 6:17 p.m., I received confirmation that $180 million had been successfully transferred to Meridian's escrow account. The acquisition closing could proceed as scheduled. I sent an email to James, Patricia, and Tyler. Meridian escrow payment of $180 million successfully completed. Wells Fargo had frozen the transfer due to authorization protocol issues, but all documentation has been provided and funds are now in escrow. Future wire transfers of this magnitude should be coordinated through the Treasury to avoid similar delays. Tyler responded immediately, "Thanks for handling the banking issues. We should schedule a debrief about streamlining these processes for future deals." Streamlining the processes. Translation: figure out how Tyler can do this without needing my involvement so he can pretend he knows what he's doing. The next morning, November 10th, James called me into his office. Patricia was already there, along with Tyler, who looked distinctly uncomfortable. "Morgan, thank you for resolving the wire transfer situation yesterday. Tyler has briefed me on what happened. It sounds like there was some confusion about banking authorization procedures." "There was no confusion on the banking side," I said carefully. "Wells Fargo has clear protocols for wire transfers over $50 million. Those protocols require coordination through Treasury and specific documentation for large escrow payments. Tyler initiated the transfer without following those protocols, which triggered fraud prevention alerts and froze the transaction. I provided the required documentation and confirmation, and the transfer was released. Tyler mentioned that these protocols seem overly bureaucratic for someone in his position managing corporate development. These protocols exist because banks are legally required to prevent fraud and money laundering. A $180 million wire transfer from someone not registered as an authorized signatory, without proper documentation or Treasury coordination, looks exactly like potential fraud from the bank's perspective. They don't care what someone's title is or whose nephew they are. They care about following regulations that protect both the bank and the customer from financial crimes. Tyler shifted in his chair. I think we should work on getting me registered as an authorized signatory so I can handle these transactions directly in the future. Authorized signatory status requires board authorization and personal liability for transactions you sign. It's not just a credential, it's legal responsibility for properly executing financial transactions. Most companies limit authorized signatories to CFO-level executives who have experience with corporate finance and understand the liability involved. Patricia spoke up. Morgan's right. Authorized signatory status carries significant legal exposure. Tyler, as you take on more corporate development responsibilities, you'll be working with Morgan on transaction execution. She has over a decade of banking relationship experience and treasury expertise. That's a resource, not an obstacle. James nodded. Agreed. Morgan, going forward, I want you involved in all major transactions from the beginning. Tyler will be learning from you about how these processes work properly. After the meeting, Tyler stopped me in the hallway. You made me look incompetent in there. I explained what happened factually. You tried to execute a $180 million wire transfer without understanding banking protocols and it got frozen. That's not me making you look incompetent, that's you being inexperienced with these transactions. I'm VP of Corporate Development. I should be able to manage corporate transactions without needing approval from the Treasury for every detail. You're VP of Corporate Development with 3 weeks of experience in that role and 3 years total in corporate finance. I've been managing Treasury operations for 11 years, including dozens of transactions over $50 million. This isn't about approval, it's about expertise and institutional knowledge that takes years to build. You can either learn from people who have that expertise or you can keep creating problems that require those people to fix. Over the next 3 months, Lexington Technologies completed 2 more acquisitions. Tyler was nominally managing both deals, but he quickly learned that managing deals meant coordinating with me on all banking aspects, following established protocols, and acknowledging that institutional banking relationships don't care about organizational hierarchy. The second acquisition went smoothly because Tyler asked me to handle the wire transfer coordination from the beginning. The third acquisition had a minor hiccup when Tyler tried to negotiate wire instructions with the seller's bank directly, but he called me before submitting anything to our bank and we fixed the issues before they caused problems. In March, 6 months after the Meridian payment freeze, James called me into his office again. Morgan, I want to discuss your role going forward. Tyler is growing into the corporate development position, but it's clear he needs experienced support for transaction execution. I'm creating a new position, VP of Treasury and Corporate Finance, reporting directly to me. I'd like you to take that role with responsibility for all major transaction execution, banking relationships, and financial operations oversight. This would include a significant salary increase and equity grant. The promotion came with a 46% salary increase, equity in the company, and formal authority over all major financial transactions including Tyler's corporate development deals. I accepted. Not because I needed validation from James, but because the promotion formalized what had always been true: institutional knowledge and expertise matter more than job titles, and companies that recognize that survive while companies that prioritize nepotism over competence create expensive disasters. 1 year after the Meridian payment freeze, Tyler left Lexington Technologies to pursue entrepreneurial opportunities, which meant James finally acknowledged that putting his nephew in charge of corporate development was expensive family favoritism that the company couldn't afford. Tyler's replacement was an experienced M&A executive with 15 years at major investment banks who understood banking protocols, treasury operations, and the importance of working with people who have institutional knowledge. 2 years after the payment freeze, I ran into Tyler at an industry conference. He was working at a small startup in a business development role, no longer a VP, no longer managing major transactions. "Morgan," he said awkwardly. "Good to see you. Congratulations on the VP role at Lexington." "Thanks. How are things at your new company?" "Good. Smaller deals, less complexity. Probably more appropriate for my experience level." "You learned an important lesson from the Meridian situation. That banking protocols are more complicated than I thought. That expertise matters more than connections, experience can't be shortcut through family relationships, and smart executives learn from people who know more than they do instead of pretending they can figure everything out themselves." The lesson isn't about revenge, though watching Tyler learn that banks don't care about whose nephew you are was satisfying. The real lesson is simpler: institutional knowledge, banking relationships, and operational expertise are built over years, can't be transferred through job titles, and matter more than organizational hierarchy when transactions involve 9-figure sums and regulated financial institutions. Tyler thought being VP meant he could manage $180 million wire transfers without treasury coordination. What he learned was that banks have protocols that exist for regulatory reasons, that fraud prevention teams will freeze suspicious transactions regardless of who initiated them, and that unfreezing those transactions requires exactly the kind of institutional knowledge and banking relationships he didn't have. Thanks for staying through this story, everyone who understands that some expertise can't be faked and some relationships can't be replaced by promotions. If this resonated, if you've watched nepotism create disasters or seen inexperienced executives learn expensive lessons, subscribe and share your experience. These workplace tales remind us that competence beats connections, expertise beats titles, and sometimes the person who saves the deal is the one who wasn't in the family tree. Your value doesn't come from your job title or who you're related to. It comes from knowledge you've built, relationships you've maintained, and expertise you've developed over years of actual work. And when 9-figure transactions freeze, the bank calls the person who knows what they're doing, not the person whose uncle owns the company.